All right. It says we're live. So, good afternoon, everyone. Welcome back to our weekly news broadcast here at Fintech Nexus. Obviously, formerly Landed Fintech. We'll have all of our graphics eventually updated, but thank you for joining us to talk weekly news. Before we get into our stories, we are joined by a couple of guests today. First, Peter's off. So, Peter, hope you're enjoying your time off. John is with our editorial team here at Fintech Nexus. And then we're also joined, I think, by the second or third time by Kim Gerhardt. Kim, maybe just do a quick 30-second intro to
Yeah,
remind the audience who you are.
absolutely. Well, first of all, thank you so much, Todd and John, for having me on again. I'm so looking forward to being with both of you today. I'm Kim Gerhardt. I'm owner and principal advisor at the Fintech Interactive. We're a management consulting company and an advisory firm that's really focused within digital financial services. We do both consulting projects, management consulting projects on different trends in the industry, consumer credit risk scoring, for example, contactless payments, point of sale finance, omni-channel merchant acquiring. But in addition to consulting projects, we also advise leading fintechs to scale their businesses. And we're working with some now that operate within the fields of fair lending, fraud, particularly at the point of online account acquisition, machine learning and AI tools and technology. So we're keeping very busy, but thank you so much for having me.
Of course, great to have you back, and so we'll jump into our stories this week, and I think you'll see a trend in a lot of these stories, which is while is a lot of news and a lot going on, it's not necessarily good news, and so there's a lot of turmoil going on in the markets, crypto and broader fintech and broader banking as well. And so the first story we're talking about is BlockFi receiving a credit facility from FTX. FTX extending obviously the credit facility to BlockFi. I think there were a couple of other pieces to the story. One, which was FTX reportedly helped liquidate Celsius, which is actually a BlockFi competitor, and then extended the credit facility to BlockFi. And this is also not only, the I think maybe second or third firm now that FTX as of today has helped in terms of this crazy time in crypto. Prices have dropped to the floor. A lot of companies are starting to feel the pressure. And FTX is one that obviously is still able to, to keep their head above water, and kind of step on the gas in some ways as well. What are your thoughts on kind of what's going on, not only with this story, but maybe in broader crypto is going to be a theme here today?
Well, I mean, I think there's no doubt that there's a lot of trouble in this new ecosystem between values of the underlying currencies as well as companies under pressure. I think I think FTX is a very formidable player in this market, and they're definitely invested for this success of the ecosystem, and they're playing their part to help play a role. I think BlockFi, in addition to Celsius, they've been put under a lot of pressure through the years, and have really been kicked around a bit in the market. I think that this latest bit of news is a bit troubling because it feels like BlockFi needs to be saved. But what I do like is their PR about it. It seems like they're really breaking away from being apart and different from Celsius. They're very focused on making sure that their customers are going to remain, solvent and all of that good stuff. So I think it gives them a chance to break away from some of the past. But, I think it's still a little bit too soon to tell in terms of, is this going to be enough to really help them?
And I
As
think
a
part of the sorry, John, I was going to say part of the issue right now with Celsius, and then John, I'll let you jump in as well, is Celsius has essentially gone completely quiet
Mm-hmm.
on not only the market broadly, but their customers. I think they
Right.
hosted, I think it was the other day, they said they would no longer host a weekly AMA or Ask Me Anything session with customers. And so not only did they send out the email, hey, we're cutting off withdrawals, but then they've gone completely dark and have left a lot of people in a lurch, not only market participants beyond themselves, but really their customers. And that's not a good signal for the company.
As a journalist of 30 years who has started and grown his skepticism, I was looking at this with crooked eyes, I guess you would say, and so were people on Twitter when you look at the responses to Zach Prince's post saying what was happening. There was quite a bit of indignation and faux surprise. So it was a bit shocking, but I think the people who have been following this were less shocked and surprised given what's been happening.
All right, let's move to our next story, which is obviously the end of the neobank era. This is from our friend Ron Shevlin, writing in Forbes, who's also with Cornerstone Advisors, friend of the show, who's been on a few times. The interesting part of the neobank market, and I think we all eventually maybe saw this coming, was there could only be so many neobanks. While a lot of them got, the momentum of, the Chimes of the world, after you start going down the scale a little bit, it's hard to rely only on interchange, and it's hard to rely with, say a few 100,000 or maybe a million, million and a half, 2 million customers. You really need to get 5, 10, 15, 20 million customers to really sustain a business over time, unless you're able to roll out some of what say SoFi's rolled out, or some of what's Varo and others have rolled out, which is more and more products. And so it's an interesting space where the neobank market is today. What are your thoughts on kind of the status of neobanks? And the impact, I think, has been big that they've been felt, but I fear that some of these companies are going to go by the wayside.
Yeah, I mean, I'm a big proponent of, product breadth, exactly what you were just saying. I get nervous whenever any one company is relying upon too much of one product, especially with the neobank. The neobank value prop is really trying to go after those niche segments that a bank or that mass, bigger banks are just traditionally not serving as well. That was sort of the promise for a lot of this stuff. So, I kind of think that the winners are still going to be the ones. I really like Ron, and I really like, what he writes, and he can be snarky. I agree with many of the things that he's, saying in this article. I definitely agree that product breadth plays a very big role. I totally agree that there's a lot of competition in the market right now. He's sort of, though, saying that the niche play is out of favor, and I don't agree with that point. But I do think that if these players can remain, it's all about the products that you give to your customer. It's all about the perceived value. What kind of problems are you trying to solve for them? And I think at the end of the day, it's, well, what are customers going to be willing to pay for? That's the business model. So, I'm still hopeful for neobanks under the conditions that they are providing multiple products for those niche segments that they're trying to serve.
I love Ron's snark. It's one of my favorite things about him. I agree with his main point, I think, which is interchange isn't a reliable revenue source. And he goes pretty heavy on that, saying that relying on interchange for revenue was a good idea. Some of the proponents of that, and he's always said that's just not the case. The proponents say they'll expand into other revenue sources at some point, and he says we're past some point. And it's like, yeah, it's getting to a point where the thinner players, the margin players, are going to be shoved out at least temporarily. My question is, do we see it returning again and opening up space for those niche players?
Yeah, I mean, maybe. My fear of neobanks was always, can they siphon enough from the traditional banks, the JPMs, the Cities, the Bank of Americas, because what Chime did was bring a lot of people who were on the edges of the financial system and not in the financial system in, and they're very much paycheck to paycheck or living near, not necessarily the poverty line, but on the lower end of the income scale. The golden customer of the JP Morgans is, the people who have more money, and neobanks haven't been able to siphon some of those people off. And over time, unless you can really build up on the smaller balanced customers in the millions of customers, gets to be a hard math problem, which I think you're starting to see. At the same time, you've had Square and like Ron points out, PayPal and others have just doubled down with their capital on various product sets, adding crypto, adding all these different types of products that are putting so much pressure on neobanks to figure something out. And I think a lot of them will probably be scooped up by traditional banks. And you'll probably see another wave, when this dip hits, its bottom and we start coming back out of the other side, you'll probably see another wave of neobanks say, all right, this is going to be our time. But I think we might be seeing the end of maybe the first batch.
Yeah, and this isn't even really the beginning. I mean, there have been some that have preceded this, like Movin. I was a customer of Movin. Simple, exactly. I was a customer of Simple. So, some of them have already come and gone, but there are some, again, that are kind of providing more product and service for their segments, like Greenlight. I'm very bullish on Greenlight, and they provide a service that I'm willing to pay for. So again, what is the problem that you're trying to solve? What kinds of services can you create? But more importantly, what can you create that people are actually going to want to pay for?
Yeah, exactly. Speaking of, sure, go ahead, John.
Speed was rewarded initially, and now we're looking at, as Kim says, who's actually solving the pain.
Speaking of a company that's got a lot of publicity and now has pretty quickly changed course, which is Brex. And so Brex made their name on serving startups with essentially a corporate card. They were able to serve small businesses because of their great technology. And then we learned that, and to be fair to Brex in one way, they did kind of tell us about this move a few months ago, saying, they were looking to focus more on enterprises. Now, I don't think they gave a hint that certain businesses would essentially be cut off, but I thought the way that they described the businesses that they're looking to serve are ones that have raised some sort of outside capital. And so, that as kind of the marker, I thought was weird. I would think that they'd probably start with maybe revenue or profit, and they didn't. And it's oddly enough, when they started, they were, a lot of publicity, a lot of technology, a lot of craziness in the market. They've raised a lot of money, and now they're, kind of acting more like a bank, which is, we can't make enough money on these small companies, 1, 2, 3, 4 person shops that maybe live on Main Street and have, small margins. Now we have to go to the big corporates like DoorDash and others. And so, as much as fintech has disrupted banks, they're also in a lot of ways starting to look like them at the same time.
Yeah, I mean, I think, and Todd, we talked about this the last time I was on the show, when Brex announced that they were moving into software. I think all of that sort of made sense. You get that recurring, more stable revenue stream, and we were talking about product diversification. All that makes sense. What I think, the way that I interpret this newest development is that it's not necessary. I'm not that offended by what they did in terms of rationalizing what customer segment they want it to go after. I think that it probably does make sense. It was really just how they did it. Yeah. That's the thing that's troubling me, is that the PR with all of this, I think was atrocious, because or it's even the media, the way that they're reacting is very harsh, but it feels like they're leaving a lot of businesses in the lurch. I actually think that there's a lot of companies that are out there that are trying to serve this segment. I don't think that SMBs are going to be left out into the lurch. And I do think that Brex, probably what they're doing is they're looking at, well, what are their segments that are the most attractive to where they are right now?
Yeah.
And they have likely very good reason to go after the enterprise, because SMB is difficult. It's riskier. It's more complex. You don't know who that other side of the business is in some cases. Fraud, can be higher. The question that I have in my mind, though, is do they feel confident that they're setting themselves up to really be successful with these large enterprise clients? And that's just a question that I have in my mind. It's too soon for me to kind of guess if they're going to be successful or not.
That's been the common theme.
Large enterprises. What was that, John?
It's been a common theme that I've noticed in the last 2 weeks, in that their ability to get out in front of this is shockingly poor, and having no real messaging prepared for softening the blow, getting to their clients first before it goes public.
Yeah.
It's the Wild West in terms of making these changes, flipping switches.
Yeah, I kind of feel like it's the business justification is probably there, but the execution, I'm very disappointed in the execution.
They would have been better off figuring out a fintech to partner with and kind of transition the smaller accounts to them. And as they scale up, then they can go back into the Brex ecosystem. Moving on to the next story, I'm surprised it took this long to get an ETF, a futures ETF that bets against the price of Bitcoin. But ProShares has launched the short Bitcoin strategy ETF, which will go live on the NYSE under the ticker BITI. And with the continued crazy swings in prices, it's not surprising that someone created a product like this. I think you'll continue to see really big swings. It'll probably bottom out at some point, like it did in 2017, 2018, and kind of slowly build back up. I think crypto is in an interesting place right now. I think a lot of people still think it's inevitable that we're on a path to blockchain enabled financial services. What that version of is, I think, is still being figured out. But as opposed to maybe 2018, when people were still skeptical of the broader technology. So I think that has benefits to it. But this specific story, I mean, it's not surprising that someone created a product to capitalize on the downward side of the wild price swings.
Yeah, I mean, this is just another example that you could point to in terms of that this market is growing up. There's longs and shorts that, normal investors kind of do, for decades and decades. And this product is approved by the SEC, and people are now trading and looking at the volatility on the downside as well as the upside. So I think that this was interesting and not too surprising.
Yeah, I think this will come out in the wash, and we'll see. This is a real opportunity, I think, to solidify going forward the mainstreaming. And someone said, I read today in a tweet, that decentralized finance is dead, in as much as on its own as something that can evolve into mainstream acceptance. And to Todd's point about there being kind of a blockchain latch on to traditional centralized finance is interesting.
What's funny is if you listen to the true decentralized enthusiasts, they've made the argument that DeFi has yet to break.
Right.
The true DeFi
hasn't even started yet.
And so
right.
it's all a matter of perspective and what you consider DeFi and CeFi and TradFi and crypto. I mean, to me, the worlds are blending. I don't think we figured out how to blend them all together yet, especially with regulators for in large part sitting on the sidelines or at least waiting to see in many cases. But I think there's still a lot to figure out there. We have a few stories left. I'm going to combine a couple of them in a second, but at first I wanted to go to, it was kind of a sneaky move by Congress. There was this talk of a bill that would go for a vote on overdrafts. This is one area, if you go back to our neobank story, without the neobanks, Dave, Chime, many others, I don't think the banks would have ever felt the pressure to change their overdraft policy, which is a huge windfall for them, billions of dollars a year. And so if you talk about success of fintech, that's one of the biggest successes. But I think maybe some cooler heads in Congress finally prevailed that we actually don't need congressional forcing of overdrafts because the market kind of figured it out itself. Fintechs pushed banks. Banks then said, we're going to lose customers if we don't do this. Banks figured out different ways to adjust their policies. Many banks still need to do it. But over time, I think you'll see almost all banks will go to the policy of you get a grace period, or you don't allow overdrafts, or you'll have overdrafts that are priced more reasonably.
Yeah, Todd, I completely agree. I mean, it's clear that over, the recent trend has been for banks to really respond, eliminating the fees or reducing them or buffering the consumers to give them a period of time to resolve those issues without a fee. Big banks have kind of been, and Cap One, I think, was leading the charge, but many other have followed. So this was a pretty encouraging development within the market that happened naturally and organically.
If I could affect an accurate Australian accent, I would speak as Peter on this because it's one of his biggest pet peeves. And so I'm sure he'd feel the same way. And I agree that it's perhaps they realized they were overstepping in something that's really not needed because the industry has spoken.
So now we move on to, probably the biggest, existential question facing fintech now. We have a couple of stories. One is on the, one company specifically, which is Klarna. They're reportedly going out to the market, raising more capital at a valuation of $15 billion, which sounds big. But if you knew that they were raising, I think it was last year or at least sometime in the last 18 months at $45 billion, you'd be pretty surprised that they've dropped to a third of that valuation at 15. And then there was another piece in the Economist, some of it from, kind of what was going on at Money 2020 Europe, which I was at as well, which is, after this great period post global financial crisis, when fintech finally kind of took hold and took off, are we at the point where fintech is maybe not in trouble, but facing its first real threat? Not necessarily from banks or market participants, but from the broader economy, and what that might mean to some of these business models, what it might mean to companies that rely on venture or investment capital to fund their business until they reach a certain scale where they begin to become profitable. How does that impact investors when they pull back money? How does that impact employees that work for a lot of these companies who get paid in some cases on the risk that the company will eventually exit, and they'll pay off on that risk that they took to move to a startup, maybe from a corporate. And so there's a lot of pieces to this. And I think while fintech is here to stay, I think there's going to be a fair amount of upheaval these next few years. And in some ways, it's very bad. But in other ways, you're going to find out what fintech companies, what founders, what organizations are really meant to last by those that come through this, even if just above water, but they've made it through it. I think you're going to find out a lot about founders during these next, maybe 18, 24 months.
Yeah, I mean, I totally agree. To answer that first question about Klarna, I mean, again, this could be one that falls to the wayside and gets gobbled up by another player within the market. Again, they're monoline in my mind. Their discretionary spend and the current market environment is just not well suited for this business. Between rising rates and inflation, consumer spending there's going to be a pullback there, and Klarna's got some losses. And again, you have to kind of look at, well, what's the business model, and what is, do they have a sound business in their hand? And then, in combination with that, there's a ton of players that are now entered the market. I mean, Klarna is an older player, 15 years plus, but the market has changed so much, and there's a lot of activity in this space right now. But I still kind of view them as very discreet in what it is that they're offering to the market. In terms of the broader fintech, I think that it's going to push everyone to the limit in terms of really testing the business models that they have. What are the problems that they're trying to solve? What are the products that they're putting out into the market? What is the ability and the willingness for customers to pay for those services? Really looking at your business model, both on a revenue side and the customers that you're going after, but also your costs. And can you think like a financial service provider instead of just a technology provider? Mm-hmm. So I think product diversification is going to be big. I think there are going to be losers. And I think that incumbents will likely get great deals with good technology, good customers, great products. I think that there's going to be many more changes happening in the market over the next several years.
I would think that Apple's announcement was something that sent some shockwaves through the industry, saying, "Oh, we're just going to do our own BNPL. So we'll just eliminate everyone else is doing this. We've got all of the scale, we've got all of the backing, all the tech, the wherewithal. We'll just come in and eat all your lunches. Thanks for your idea." That's a pretty terrifying prospect that Apple or Google or Stripe or PayPal can just come in and say, cool idea. We're going to do that.
Look at the cost of customer acquisition in those cases. Right.
Yep. I mean, I think banks could, you said it, Kim, I think banks might, a couple of years ago, people were like, all right, when are banks going to feel the pressure? They made some changes to their fee structures. They made some changes to their overdraft policies. But now I think they might be heading for a windfall, not only with, like you said, companies, the valuations drop and they need to sell off cheaply, but also customers in the face of rates and inflation are going to go to the safest bet in the market. And unfortunately, that's most likely going to be banks. Yeah, there'll be some fintechs that are able to kind of square up against banks, the lending clubs of the world, the SoFis, but they essentially bought banks to become a new version of a bank. And so it's going to be interesting to see, the fintechs that not only survive, but the ones that kind of retool and adjust. And then how big of a windfall do banks end up getting through technology acquisitions, acqui-hires, and customer acquisitions through some fintechs that just need to sell to save some face in many ways.
The perception of credibility score is going to be really important. You might have the backing needed to deliver, but what's the perception in the broader public of that? That's going to be the thing.
I'm still bullish though on the industry.
Oh yeah, for sure. I mean,
fintech. I still think I see so much promise in fintech and solving real problems that are out there. Again, you just have to kind of go back to the fundamentals.
And the one thing that doesn't change in markets like this is, growth capital might disappear, but early stage capital is still very much funneled to companies. And there's going to be some companies that we have no idea that exist today or is just starting today that are going to burst on the scene in the next 18 months. And so that early stage money is still going in. And so there'll be plenty of companies that we, unearth in the next couple of years that become the next, household names. Maybe they become the next Klarnas, the next SoFis of the world. So, and on that note, we're going to have to end since we've hit our time here. Kim, thank you very much for joining us again.
Thank you so much for having me. This is always so much fun.
And John, thanks for joining us. Next week, we'll be back with Peter, myself, and another special guest. Thank you, everyone. Enjoy the rest of your Thursday.
So long. Thank you so much.
Thanks.